Are you maximizing your opportunities when it comes to the 2017 Tax Cuts and Jobs Act? A little knowledge can go a long way towards saving you money and helping buyers and sellers. I'm Joanne Koontz. I'm an attorney and CPA with Koontz & Associates in Sarasota. Let's take 5 minutes to go over some key points that you should know about the Act and some talking points for your buyers and sellers. First, if you haven't yet incorporated your real estate business, you should do so immediately. There are essentially two ways to incorporate for real estate professionals: a professional association called a PA, or a professional limited liability company referred to as a PLLC. Either of these two entities offers not only liability protection, but also the option to file taxes as an S corporation to maximize your tax savings. Prior to the new tax law, there was a substantial savings for realtors to form a PA or PLLC, so you could elect to be taxed as an S corporation with IRS. As such, you would be exempt from paying the 15.3% self-employment tax. Now, as a result of the new Tax Act, you would also be eligible for the 20% business deduction, which is a reduction of taxable income for your business by 20%. This is in addition to the 15.3% self-employment tax savings. As with all tax laws, there are many factors that affect your specific tax outcome, so be sure to speak with a CPA for your specific circumstances. A second interesting part of the new law is that entertainment expenses are no longer deductible. So if you regularly purchase tickets and took clients to sporting events, plays, musicals, or other such activities, you can no longer deduct that expense. However, professional sports teams don't want to lose group sales packages, so they will be coming up with creative corporate sponsorship packages. Ask the venue if they offer a corporate sponsorship where you can buy a certain number of tickets, they'll place your name on the program. There are many other ways to benefit from the new tax law, so make sure to meet with your local tax attorney to discuss how you can take advantage of all of the new deductions. The new law also offers some exciting opportunities for you to find prospective clients. For example, there's a new $10,000 limit on state and local tax deductions, including real estate, income tax, and sales taxes. For residents of high-tax states such as New York, Connecticut, and Massachusetts, it's a perfect time to move to Florida, where there's no state income tax. Use this information in your marketing materials to potential out-of-state buyers. Next, mortgage interest is now capped at $750,000. Buyers with jumbo loans may want to consider putting more money down when buying an expensive home. The new law further repeals deductibility of interest on a home equity line of credit. However, if the funds can be traced back to a business purpose, such as acquiring or renovating a rental or investment property, the interest is deductible on the appropriate business tax return schedule. If you're working with investors, they would benefit from this information. Another bonus for investors: clients buying real estate rentals and investment property can now deduct most of the improvements and renovations between the new rules under Section 179 depreciation, bonus depreciation, and the repairs and maintenance regulations. That's great news to pass along to your investor clients. Remember, there are many nuances to a law such as this. Always leave the advising to a tax professional or attorney. And to maximize your money, meet with your tax advisor now to make sure your business is structured in a way that nets you the most deductions.